God, I still remember when we were going, what are we going to do with all of this parking lot? We're going to have to park the cars like 10 feet apart to kind of fill it up so it looks like we got, got some cars and stuff.
Right. That didn't last long.
No, it didn't.
Welcome to Talking Shop. I'm Clint Newell, president of Clint Newell Auto Group in Roseburg, Oregon. Talking Shop is a show where I sit down with some of our employees here at the dealership to discuss current topics in the auto industry. From time to time, I'll also sit down with members of the local community to discuss other business topics and current events. We'll share insights and stories about business, community, and what's going on today. You can anticipate learning tips and tricks on how you can save money at the dealership, get better deals, and take better care of your vehicle. And hear some awesome stories from successful people in our community. I hope you enjoy, and thank you for listening to Talking Shop. Welcome to another episode of Talking Shop. I'm here today with Denzel Hagedorn, one of our customer finance managers here. And Denzel, you've been with us a long time. It was 25 years last summer, and like they say, how time flies when you're having fun, right?
It does.
Yep. Anyhow, Denzel, you've been through a lot of eras, a lot of trends, through the financial cycles of our industry and the business in general, through high interest rate environments, low interest rate environments, changing lending practices, all kinds of things. So, I thought we'd just spend a few minutes today talking about some of those things and where auto financing stands today, and what people should keep in mind when they're financing a car or looking to buy that next car, and some of the important factors.
Sounds good.
Yeah, one of the things I thought we would start with is just interest rate trends. I mean, we all remember clear back into the 80s when rates were sky high.
Yeah.
And, then after the financial meltdown into 2009, rates went really super low and have stayed relatively low since. And really, it's just been in the last year or two where we've started to see a slight elevation in rates over that period of time. But what are your observations on that? What's your take?
The rates are creeping up a little bit.
Mm-hmm.
Last year or two, they've come up some, but they're still pretty low. Like you said, compared to the 80s. Actually, I was looking through some old paperwork and found that if you had great credit, your rate might be 13% back in those days.
Right.
And if you didn't have great credit, it could be 30%.
Right.
So it's still pretty low, not quite as low as it was a couple of years ago.
Right, but still, really pretty low historically in the overall scheme. I mean, our rates are obviously lower than they were in the 80s. They're lower than they were in the 90s, and they're lower than they were in the 2000s.
Yeah.
Really, it's just, the last 10 years that we've had, that super low interest rate environment, and we really haven't even caught back up to where it was 20 years ago.
Yeah, and hopefully we've kind of stabilized a little bit. The economy took off real fast. The Federal Reserve starts raising the rates to the bank and
Right.
and at a real fast pace, trying to slow things down. And so for a while there, we were kind of going up. Hopefully, we've kind of stabilized now. It seems like we're still at a good spot, but not shooting up so fast.
Yeah, it seems historically that the Fed typically overreacts when they start raising interest rates. It seems like every time they've done that, I look back now and they went too far and had to back off.
Yeah.
And, I'm hopeful that this time maybe they backed off a little sooner so that we're going to avoid some of that overreaction.
Yeah, you don't want to.
In elevating the rates.
You don't want it to be so high that it hurts everything.
Right,
so.
that it slows the economy down and begins a recession. So hopefully that's not happening.
Yes.
Yeah. So you mentioned credit ratings and credit experience and whatnot, and how that might affect your interest rate. What are you seeing today in terms of people's credit? How does that affect the rates that they pay on their car loan?
Well, it can have a giant effect.
Mm-hmm.
Luckily here, most of our customers have pretty darn good credit.
Sure.
So the people that I have to deal with usually it's very easy for them to get a loan. They get great rates, and whether they want to put down payment down or not doesn't seem to affect things. We still have a few people though that are a little more challenging, and that's where I have to get put to work.
Well, everybody has a different story, and everybody's had different encounters credit-wise where things have happened. And, there's a lot of people that have gone through some really difficult circumstances, so, kind of looking at the range today, from, for a rate for really super good credit to somebody that's trying to rebuild their credit. What are the ranges you're seeing right now?
We're going to see somewhere between about 4 or 5%, and generally for us, if they don't have very good credit, it might be as high as 25% or so.
Okay.
So it's a pretty broad range, and it depends on a huge amount of factors: down payment, job time, actual credit rating, what they're buying, whether it's new or used. There's a lot of factors that go into it. So we have to take all those things into account when we're talking to the bankers.
Sure. And then, we have, both with General Motors and Toyota doing manufactured sponsored lending where we have 0% on some things. Tell everybody how that works.
Well, usually it's specific cars or specific trucks. The manufacturers will have 0% for 60 months or something like that. Usually you get that rather than a rebate. Sometimes there's a combination of the two, though, depending on the vehicle and stuff like that.
Sure.
But if you have 0% interest, you can finance a car and pay no interest through the whole term. And so
what if your credit isn't very good? Can you still get 0?
Sometimes, but it makes it tougher. It's important to have good credit generally on those programs. If your credit is really bad, usually they won't let us use those programs.
Sure.
But they do have programs where you can get a loan at an interest rate that's higher, but it's still much lower than you might have paid normally on this factory sponsored type things. So,
sure.
So that helps for the people who don't have that great of credit rating.
Right. Sometimes that can save a deal, so to speak.
Yep.
Obviously, credit comes into play with interest rate, but it also comes into play with your borrowing limit, how much you can borrow to finance a car. And sometimes it can be, based on a total amount. Sometimes it can be based on a percentage of the vehicle value. What do you run into there these days in terms of borrowing limits?
Well, and like all of these things that we've been talking about, your credit rating has a huge amount to do with with what you can do.
Right. That's what I'm getting at.
If you have great credit, you can kind of borrow whatever you want to borrow. If you don't have great credit, then you may need to either buy a lot less expensive vehicle. You may need to put some money down. There's just a huge range of all those things in between.
Right.
And that's where we come in, where the finance guys will talk to the bank and try and work it out.
Somebody with some credit flaws, what kind of percentage of the vehicle value can they typically borrow?
Well, if they've got some credit flaws, we generally need to be back of invoice or book value on things because the banks want to be safe.
So at or below a wholesale value is what you're saying.
Yeah. They want to be safe. Not saying that it's going to happen, but if they do have a repossession or something like that, the bank gets it back or Toyota Financial gets it back.
Right.
They want to know that if they get that car back as a repossession, that they can sell it and not lose a bunch of money.
Right. Not be in a big loss position. Right. Sure. Obviously, another thing that affects your payment limit, your borrowing limit, is your income. So what kind of income ratios do we run into today?
Usually it's about 15, maybe 20% of what they call your payment to income ratio. So if you are buying a car and you make $2,000, they're not going to let you have $1,000 car payment on that.
Right.
It's,
So 20% of 2,000 would be like a $400
right.
payment.
That would be generally the most they would want to do.
And that's based on total household income, right?
It's based on it's who's on the contract, who's on the credit application. Sure. So they'll take all of that into consideration, but they will make exceptions. If you have exceptionally good credit, they will make exceptions to those.
Sure.
They will look at that and go, you know what? They've always paid for everything. They're probably going to figure out how to pay for this one too.
Right,
So.
right. So obviously, working with a lot of different lenders has a lot to do with the final outcome of what we deal with. So talk a little bit about, how many lenders you typically deal with on a regular basis and how you work that to find a customer the best rate, the best terms, the best payment and all that. Because a lot of people don't understand how that works today. But, obviously we try to get the best scenario put together for the customer. Why don't you talk about that for a second?
Well, we have a lot of lenders, a lot of banks. We have GM Financial, Toyota Financial, a lot of credit unions, things like that.
Yep.
We try and keep track of where everybody's at, and usually they will use credit ranges to kind of set your rates. So for the most part, in our own heads, we can usually kind of narrow down, okay, it's going to be one of these 2 or 3 lenders, something like that. Especially for the folks who have great credit. If they don't have great credit and we have to shop around a little more, we may send it to 6 or 7 different lenders.
Right.
They all have computer programs that they run anymore. It's not necessarily a person making a decision. Sometimes it's a computer making a decision for the banks, and they will kind of say, okay, here's what we'll do, and then we could take the best one from those for the customer.
Right. And we have a lending portal available to us with Route 1.
Route 1.
So sometimes we'll put a deal into Route 1 and just see who makes the best call.
Yep.
So talk about how that works a little bit.
Well, we have kind of 2 portals that we use, Route 1 for the banks and GM Financial and Toyota. And basically we can put in who you are, what you want to buy, how much it's costing, click a lender or click multiple lenders, and they will tell us, here's the rate we're going to give you, and here's the term we're going to give you, that kind of thing. We can do the same thing with Cuddle. It's a credit union lending.
Right.
And we can click on multiple ones or just one if we know that who we're going to go through. Right. And see where it comes up there as far as the best rate for people, best rate, best term, all those kind of things come into play.
Right. Right. Seems like there's always something. It's rate, it's term, it's payment, it's down payment. Yeah. All those factors that are in play that we're trying to manage there. Yeah, that's a good point. But obviously, there's so many different directions we go for car loans today. It's definitely a buyer's market.
It is.
Whereas you back up 10 years into, this time in 2009, and it was definitely not a buyer's market.
The banks were afraid.
You couldn't find anybody to make a car loan.
Yeah, they were afraid at that point.
That was an amazing time. Never seen anything like it. Hope I never do again.
Yeah. That's for sure.
Right. So a lot of people, a lot of the experts, so to speak, and consultants, they talk about how getting a car loan is a good way to rebuild credit because, it gives you a chance to get reestablished, and it's probably one of the higher credit amounts you can borrow to get a credit record either established as somebody that doesn't have much credit or as somebody that's trying to reestablish and recover from some credit that went bad. So talk about that a little bit.
It's a good way to reestablish credit. It takes a little bit, though. It doesn't happen instantly. It's not instantaneous, but it's definitely a lot higher amount than you would normally get if you're trying to reestablish credit. you're generally not going to get a bank that's going to give you a $30,000 credit card.
Right.
But they may give you a $30,000 car loan because they've got some collateral on it.
Right.
So now you have shown that you pay a $30,000 loan off as the time goes by. Then the next time that it's time to get a $40,000 loan for a car, it's much easier then because you've shown, yes, I pay for this. I'm probably going to pay for that one.
So how long do you think it takes for somebody's credit score to get a positive reaction on, reestablishing and taking out a new car loan? How long before it really starts to rise?
It's generally going to be probably 6 months to a year at least. When you first get that loan, it actually dips down
it's
just
going to
a
go
little
down,
bit
right?
because you're taking on a new debt,
right?
And they look at how much debt you have.
You owe more money,
and then but then as you pay it and you've shown I pay my bill every month, then eventually that's going to kick into the positive
and start to climb.
Your rates, your
right.
credit score is going to start going up.
Right. One thing we've always encountered here, we've always had a fair amount of cash buyers. A lot of people that come in and pay cash for a car.
Yeah.
What's your view for the person that likes to pay cash? What's your thought there?
It's more of a what feels best to them. A lot of people are proud of the fact that they can pay cash for a car, and we still have some people who feel like if they offer us cash for a car, they'll get a better deal, even though it's all cash to us. If we do a contract, the bank gives us the cash.
Yeah, we get the cash either way.
So it's all the same to us.
Sure.
But they're proud of the fact that they can pay cash, and they like not having to worry about a bill. They say, well, I have no bills. Most everybody still has bills, though. We still have an electric bill and an insurance bill and a water bill. And
sure, you got your utilities,
so
you got your insurance.
You still got to pay some bills.
Yeah.
It's not necessarily in the long term the best thing for people, kind of in my opinion. I've told people over the years, if you come in and buy a car and pay cash $30,000, in 5 years, you're going to have a car that's paid for, but you won't have the $30,000.
Right.
Most people have a little extra income. So if you come in and finance a car for $30,000 in 5 years, you'll have a paid for car that was a $30,000 car, but you'll still have that $30,000 in the bank.
Right.
So unless you're a really, really good lender or a really good saver, I would say financing it when you have good credit and you can get a good rate generally is a good thing because you still have that cash down the road, or if something comes up, you still have that cash. So an emergency thing. Or
not a bad way to go. There's an old expression called, keep your powder dry.
Yeah.
Which is referring to keep some money in the bank.
Yeah.
And, maybe you put half down and finance half of it or something like that. So obviously a lot of combinations there, but some good thoughts there. Sometimes there's some dilemma on how long to finance a car. Way back when you and I were young bucks in this business, the standard deal was about 36 months, and then 48 months came. And then I remember when 60 months finally came out and everybody says, oh my gosh, this is crazy. 5 years on a car loan, so obviously a lot of things have changed that we don't think about so much, but cars last so much longer today than they did back then.
Yeah.
And, back then you rarely saw a 100,000 mile car. And if you did, it was absolutely worthless, just worthless. And today we see 100,000 mile cars as almost a norm.
Yeah.
And, cars with 200,000 miles and beyond. So with vehicles lasting longer, obviously terms have increased, but what are the trends you see there today, and what are your thoughts on vehicle term?
It seems like most of the people who want to finance rather than paying cash are looking for a specific payment. And for the most part, they want their payments as low as they can get them.
Sure.
So we have a lot of 72 and 84 month financing anymore. Is it better to go shorter term? Yes, it probably is. You get it paid off quicker, you get equity quicker, you're paying less interest. But it's still a comfort zone for people.
Yeah.
And the cars are expensive anymore.
Right.
I wish they were cheap, but they're not.
Right.
They're a lot of money anymore.
Yeah. Yeah.
And so we go longer to keep their payment at $400 a month or $500 a month or whatever they want to be. So you stretch your term out so that that's still in people's comfort zone so that they can afford the car that they want to buy.
Right. But we have a lot of people that keep their car 10 years now.
Yeah.
I mean, it's not unusual. You go back 10 years. This is 2019. 2009, you look at a 2009 car anymore, it doesn't really seem that old.
Yeah.
But it's 10 years. So if you keep your car 10 years, gee, does it really matter how long you financed it for?
It doesn't.
It may not.
Yeah. It doesn't really matter how long you financed it in that case if you're going to keep it a long time. Especially.
So obviously how long you're going to keep it, how many miles you're going to average per year, what kind of wear it's going to have, how long it's going to last you.
Yeah.
Those are probably all key things to keep in mind.
Yeah.
You bet. So that brings me into leasing.
Okay.
What about leasing? Leasing absolutely dried up 10 years ago. Everybody ran from leasing 100%. You couldn't lease a car 10 years ago, no matter who you were.
Yeah.
And now it's worked its way back in, and we're doing a lot of leasing again. So talk about that a little bit, because, there's definitely a fit there for that type of financing. I always refer to leasing as a different type of financing because it really is.
That's exactly what it is. It's just either way you're purchasing a vehicle, whether you finance it normally or you're leasing it. Generally, leasing gets you a little cheaper payment though, and that's why most people want to go with a lease. They have a lower payment. They can afford to get maybe a nicer car than they could if they were financing it. The other part to keep in mind though on a lease is you're not building any equity. At the end, a lease is designed so that you kind of break even on the thing. You're not going to have equity in it that you can use as down payment on the next one. So you just sort of have to keep that in mind.
Right.
Most of the people who lease will lease one for 3 years. They'll bring it back. They'll lease another one for 3 years, and it just kind of keeps going with that cycle.
Yeah, so it's designed to not have any equity at the end, but it's also designed to not have any negative equity at the end either.
Right.
So that's kind of the positive on that note as well. Obviously, mileage comes into play because most leases are designed for 15,000 miles. How many miles a year do you think you can put into a lease and still make it practical?
Well, generally 12 to 15,000 miles is going to work.
That's the norm.
That's the norm. If you're going to go past 15,000 miles a year, a lease may not be a good thing for you. We have some customers who put 25,000 miles a year on a car. If you set it up on a 15,000 mile lease, you're going to have a huge mileage hit that they're going to charge you for at the end of that lease.
Right, but you could set it up for 20 or 25,000 up front. It's just going to lower the residual down and drive the payment up.
And then you may not be any cheaper than if you just bought it.
Or you might be more.
Or more, yeah. So it's we try and kind of figure all that out. We talk to customers a lot and try and figure out, okay, what's going to work best for you. Some people come in thinking they know exactly the best thing for them. After we talk to them for a little while, sometimes they realize it may not be. Leasing may be better than buying or vice versa.
Yeah, I always like to present both to where you can see what the lease is, what the purchase is, maybe a couple different terms, and see which one makes the most sense, what looks most attractive. Yeah, because you just kind of have to lay it out because it varies a lot from car to car as well.
Yeah. But we have to ask customers how many miles they're going to drive and stuff like that. Some folks don't necessarily know what we need to know to figure these out, so they don't just offer it up that they drive a lot of miles and stuff like that. So on the vehicle that they're getting, whether it's a lease or buy, how many miles they're going to drive, what they're going to do with it, if it's a truck, if they're going to tow with it and stuff like that. People may think we're asking a lot of questions, but it's things that are supposed to help us figure out, okay, is this really the right vehicle for you?
Right. It helps us do a better job.
Yeah.
You bet. Well, obviously we've talked quite a bit about financing. There's other things you do too. And one of the big topics in the finance office is extended warranties.
Mm-hmm.
And so talk about extended warranties a little bit and what you see there today and what else going on.
Well, it's like the price of cars. They keep going up a little bit because
repairs are more expensive.
I was going to say, because when something does go wrong, repairs are a lot more expensive.
Mm-hmm.
And I try to advise people when they're in my office, whether they want to get an extended warranty or not, what's going to be the best for them. Generally, if you're going to keep a car for just a couple of years
Mm-hmm.
and then trade it back in, I go, well, you probably don't need one because you
Right.
got a 3-year, 36,000-mile warranty on the new stuff anyway.
Right.
So
So if you're not going to really keep the car beyond that,
then
it's
you
not
really
going to
don't
provide
need
you
it.
as much value.
If you are going to keep it a long time, then I generally recommend it.
Mm-hmm.
Nobody knows exactly what the best thing is to do. I don't, they don't, nobody knows because nobody knows what's going to go wrong. They don't know when.
Well, it's insurance.
Yeah, it's insurance.
Yeah.
I always have them on my vehicles because it makes me feel better.
Right.
It's worth the extra little bit a month for me not to have to worry. When the check engine light comes on in your car, you don't know if it's going to be $50 or $5,000 to fix.
Mm-hmm.
And when I take it in the shop, I go, hey, fix this stupid thing. I
Right.
don't want to have to worry about it. You know, I don't care what it costs because I don't have to pay for it.
Sure.
And I like that feeling.
Yeah. Yeah. You know, another thing about extended warranties is that, you know, like the life expectancy of cars these days, extended warranties have gotten longer as well.
They have. We can go out 10 years now.
Right.
On stuff, and so I definitely am making people plan for potentially way into the future.
Mm-hmm.
And not that cars are bad; they don't break a lot. But in 10 years, you got a zillion things on cars
Right.
anymore. Something's going to go wrong, and it won't be cheap to fix it.
Right.
Nothing's a couple $100
Yeah.
anymore. It's either lots of hundreds or lots of thousands to
Yeah.
fix most anything. And the things that go wrong aren't the engine blowing up. It's some little microchip thing inside of some other square box that goes wrong.
Yeah.
You know, and
Uh-huh. Electronic repair.
yeah.
Sure. Yeah, obviously with all the technology in cars today, you know, there's expense there, and you know, there's things that have to be dealt with, and you know, if somebody keeps their car 5 to 10 years, chances are they're you know, probably going to get their money back on that
They're going to use it for something.
at some point. Yeah.
And like I say, I've told people again, I don't know if you're going to come out way ahead or not,
Mm-hmm.
but is it nice to not have to worry about it for the next 10 years?
Mm-hmm.
If you come up a couple $100 short, you'll grumble and complain a little bit. But if you don't have it and something breaks and it's $4,000 or $5,000 and you have to come up with $4,000 or $5,000, you're really going to grumble and complain a lot.
Uh-huh.
And so one of them's bad, the other one's just way worse.
Right. Sometimes that's how it goes,
Yeah.
right? So, obviously, financing, extended warranties. What are some of the other things that you like dealing with in your office?
Well, as far as things that people can get, you can get gap coverage now.
Yeah, talk about gap. What is that?
It used to be that you had to put money down on a car years ago.
Mm-hmm.
And so you were generally always in an equity position. Nowadays, most of the lenders will, if you have good credit, will lend on a car without money down. They will even let us take in equity from your old vehicle, pile it on to the new loan.
Mm-hmm.
So now you have negative equity going in.
Super negative equity.
Yeah. If you happen to get in a wreck, somebody
Yeah.
runs into you, the car is totaled, the insurance will pay off a certain amount, but they generally in a super negative equity position, they're not going to pay off your whole loan, and
Well,
you're still liable for it.
Yeah, you know, physical damage insurance is going to cover the fair market value of the car.
Mm-hmm.
So obviously during the first year or two that the customer owns that car, they haven't had a chance to pay down that balance on that loan yet.
Yeah.
So the balance is obviously greater than the fair market value, and that's what we call the gap.
Yeah.
And so the gap insurance covers the gap so that if somebody is what we refer to as being upside down in their car, the insurance pays that difference.
Yeah.
So that's becoming a lot more popular, isn't
It's
it?
becoming a lot more popular. If I could talk. if people have a huge amount of equity in their vehicle, I generally don't do it.
Right.
If they have negative equity, I very much recommend it to
Right.
people.
Right.
They can get it or not, but
Mm-hmm.
usually it's a good idea just in case something happens.
Yep.
So
Yeah. Good point. Good point. Yeah, you've done this a long time. Like I've said, you've been here over 25 years now.
Mhm.
You're going to be retiring soon.
yep.
And obviously, you worked in automotive finance before you came to work for us here.
hmm
And obviously, you've had a great career here and done a great job with us for a long, long time.
It's been good.
What are you looking forward to?
Just messing around my house.
Yeah,
I just want to putter around in my yard. When I'm off, I like mowing the yard and planting flowers and messing around in the garden and stuff like that. And that's actually what I'm looking forward to.
good for you. Good for you. So for whoever fills your chair after you leave here, what would be your advice for them? What would you recommend to your successor?
Probably learn to be patient. Sometimes I'm not the most patient person, but try and be patient. Learn to talk with the people at the bank, especially on the people who don't have great credit. A lot of times we basically have to talk to the banker and say,
Right.
you're saying no, but here's why you should say yes.
There you go.
You're maybe saying no because of their credit score, but they've been on their job for a long time. They own their house. They have enough income to pay for it.
Mhm.
Yeah, they had a hard time there for a while, but here's why you should give these people a loan.
Mhm.
And over time, you develop a relationship with those different people at all the lenders.
Yeah,
And that's very important too.
sure.
It's the kind of the side that customers never see.
Right. Yeah, there's a lot of behind the scenes that goes on there.
Yeah.
So obviously that's part of why we're talking today, just to give some people some insight as to, just one of the other things that goes on around here.
Yeah.
So Denzel, thanks a lot. It's been great. Appreciate your time this afternoon, and hope everybody's enjoyed listening in. Thanks for joining us for another episode of Talking Shop, and we'll see you next time. I hope you enjoyed the broadcast today. Be sure to subscribe to our YouTube channel for future broadcasts, and also like and share on Facebook.